Hey guys, Joel Frankie, market analyst for YouTrading, and in today's educational video, we're going to be talking about how US jobs data, which is one of the most important data releases uh, out there, how this data can impact different asset classes. Because we've just had the release of this jobs data, and we're seeing a really good market reaction. Um, Pretty much, we're seeing the dollar rallying, stocks selling off, yields moving higher, cryptocurrencies getting hit, the traditional market reaction that you would expect from a much stronger than expected jobs report that, as a result of it being strong, triggers fears about Fed tightening. But before I show you the market reaction in a bit more detail, let's just go through the numbers quickly. 263,000 jobs added to the US economy in November, above the expected 200,000. And we also saw this positive revision from the October numbers, 23,000 more jobs added than initially thought. And pretty much the hiring numbers were strong across the board. Like the private payrolls numbers were good, better than expected. Um, I mean, you could say manufacturing was a bit weaker than expected, and the recent data that we had earlier this week, saying that the manufacturing sector is actually in recession, that probably isn't too surprising. But then we did get this positive revision to the last month. And actually, the fact that manufacturing companies are still hiring means that, the manufacturing sector can't be doing too badly. It just means that it's slowing down a little bit. Um, but probably the most important aspect of this report for me is the unexpected jump in average hourly earnings. Okay, so we're expected to drop from 4.7 to 4.6. Well, as it happens, we actually rose to 5.1% year over year growth in earnings, and last month's wasn't actually 4.7. It's now been revised to 4.9, and the month over month metrics obviously strong as well. 0.6% month on month gain in wages, above the expected 0.3%, and and you also saw another positive revision for last month. So yeah, very hot labour market report here. The US economy still adding jobs at a solid pace, and wage growth still high, much higher than we were thinking actually, which is inflationary. Traditionally, that high wages can lead to inflation, or at least can mean that inflation remains sticky at higher levels. And that is why the markets are reacting in the way that they are. They're reacting by increasing their Fed tightening bets, basically. So let's actually have a look at the Fed Watch tool, the CME's Fed Watch tool, and we can see what markets are betting for the Fed meeting that comes up later this month. So as you can see here, the base case is still that the Fed's going to raise interest rates by 50 basis points to this 4.25 to 4.5% range. Around 70% expected now. But that's lower than it was yesterday, when it was more closer to an 80% probability that they're going to do a 50 basis point rate hike. Similarly, we're expecting only around 20% chance of a 75 basis point rate hike later this month, but that's now jumped to 30% in wake of these hotter than expected jobs figures. So how's that affecting markets? I already started to talk about it, but pretty much we've had a jump in the Dixie and a spike in volume that you always get after these data releases that you can see here. Big jump in the Dixie actually. We're about, how much higher are we? About 1% higher versus pre-data levels. That's pretty big. Let me show you US stocks. This is CFD that tracks the S&P 500. You can see the same spike in volume, and we're about 1.5% lower, but still holding above 4,000 for now. And then I can show you other asset classes like Bitcoin. Also saw a spike in volume, also moving lower. You can see that it's about 1% lower versus its pre-data levels, and gold also getting hit as you would expect as yields surge. Also 1% below its pre-data levels. So why are markets reacting like this? Well, when you're expecting, or when you revise up your expectations for tightening from the Federal Reserve, that pushes yields up, which increases the sort of appeal of holding holding dollars, basically, because you're getting a higher yield on those dollar-denominated assets like US government bonds or whatever you're holding. It also hurts risk assets, as I've just shown you with Bitcoin and with stocks, which increases the safe haven appeal for gold. Because when the Fed's tightening more aggressively, that's bad for the global economic outlook, which generally, when you are getting more pessimistic about the global economic outlook, but you've still got a hawkish Fed, that's generally good for the dollar. And then gold here being hit because, when yields rise, that dampens the appeal of holding non-yielding safe haven assets like gold. But yeah, guys, that's pretty much the video. I hope you all enjoyed it. I hope you all found it informative, and I'll see you all in the next one.